Hi guys, this is Prashant Rao, and today we'll talk about futures contracts and look at a few currency pairs and see what it means to trade them. In futures, as I mentioned before in my previous videos, so you can trade real time, almost 24 bar 7 on various types of instruments and commodities. Examples: crude oil, wheat, pork bellies, sugar, treasury futures. In case of futures and in forex, you have US dollar, Japanese yen, Euro USD, New Zealand USD, and a whole lot of other currency pairs. But before you place a trade, you need to understand what it means to trade that particular commodity. To understand better, let's look at a crude oil contract. So you can go to the CME group and look at the specifications of that contract. So in case of a crude oil future, one contract is representing 1000 barrels of crude oil. So that means for every cent of move in the price of oil, you either make or lose $10. And the minimum tick price fluctuation is 0.01, which is 1 cent. So now let's go back to this chart. That means if you, let's say, shorted oil when it was at 48 and then bought it back at 44, that means you made 4 into 1000, that's $4,000. So that's how it works. And let's look at an equity futures, another example. So if we look at the contract specs, it's 50 times S&P index. So for every point of move in the S&P, you make or lose $50. And the minimum tick in this case is 20.25. So let's go into the chart and see what this means. Let's go into a 5-minute chart just so things are easier. So let's say that you I guess went short at 28.75. I'm not able to place the cursor exactly right. Say you went short at 28.75 and you got out at 27.75. So that's a 100-point move in the S&P.
Sorry, I'm not sure.
So with the 100-point move in S&P, that would make or break 50 times that 100-point move, meaning it's 5,000. So that's what would happen if you place that trade. So each contract has its own specification. So before you go in and place that trade, make sure you understand how that contract works. Also, with each contract, there are separate margin requirements, and for that you can also look at the specification, or you will get to know once you place the trade. And you can see that right now, for the May crude oil, you are looking at 7,500 USD. So that's the minimum amount of money that you need to have in your account in order to place a crude oil contract. So there's usually a concept of an initial margin and a maintenance margin. The margins are calculated at the end of each day. And if you don't meet those requirements, you will be required to post more money into the account or liquidate the trade. So make sure you're not using too much leverage. and I've already mentioned about that in my previous videos. It can be pretty disastrous if you're caught the wrong way. So, um, there are, you can go and look at various other contracts. If you just use a drop down here, it gives you different categories, and within each category, you have a whole lot of instruments. You can look at them and see which ones you would like to trade. Now let's look at some Forex pairs. Let's go into the Euro USD because it might be easier to explain a few concepts. So in the Forex world, everything moves in terms of pips. So what I mean is the minimum price movement here would generally be, let's say in this case, 1.0875. Right, so as it is here. So when the price moves by a pip, let's say from 1.0875, it goes up to 1.0876, and you are long Euro USD. And let's say that you had $10,000 as part of your Euro USD trade. So that move from 1.0875 to 1.0876 will make you $1 because 0.0001 into $10,000 that you put in is $1. So that's how it works. It is not like stocks where you calculate your gain by basically looking at the increase, your final price minus initial price, and then you multiply it by your quantity, and there you go. So it works a little bit different. In this case, in case of the Euro USD, it's more straightforward. And what does it mean to trade 10,000 of Euro USD? If you were long the Euro USD with a quantity of 10,000, that means that you bought 10,000 euros and you sold the corresponding amount in US dollars. So that's what it really means. For other pairs like US dollar, Japanese yen as an example, it gets a little trickier. So it's not as simple as saying 1.07.515 minus 1.07, 107.500 is so much, and multiplied by some factor, and there you go. So it's not as straightforward. I won't go into all the detail. I think as you trade, you'll kind of figure out that because you got to convert it to USD, and USD price itself fluctuates, there are certain challenges that you encounter, and it's particularly true when you place a trade like, for example, Euro and Norwegian krone, where your account is in US dollars, but here you're buying or selling euros and selling or buying Norwegian krona. So and then eventually, once you get out of that trade, you need to convert back to USD, and at that point the equation for Euro versus USD may have changed, and that complicates your calculation. So your broker, your account will tell you instantaneously what the value of your account is in US dollars. So that's what you should really pay close attention to. I think it would help to read up about pips in general and how to do these calculations before you start and enter any trades, just so you know what you're dealing with. So with that, I think that's it for today. So in my next video, I'll talk a little bit about strategies by which you can identify some opportunities, and then we can go into some real trading. Hope you enjoyed the video, and I'll see you next time.